I think we can start now. I'll hand it over to you, Chris. So everyone will have Chris, who's been an important part of Acquira. So Chris, you can take over the mic.
All right, Andy, boy, you really just throw me right in the pool, don't you? Hey, I appreciate everyone's time. My name is Chris Mooney. I've been an investor in Acquira, I think, since around 2020. I've had various different roles in Hayden's organization, informally so. I currently work in advisory capacity for Hayden on sort of more strategic points that he's working on. One of the things I do is I'm also a GP of a few small funds, one of which was created specifically to invest in Acquira entrepreneurs. I was actually speaking to another private equity group about a deal we were actually going to sell, thinking about selling. We ended up not doing it, but and I realized that the best way to think about how we participate in a potential transaction with you is we're like angel investors for acquisition deals. So I think everyone's familiar with the idea of an angel investor in the venture capital space, where you've got sort of a first-time entrepreneur looking for their first dollars to prove out a concept. And in some ways, we play that role as well. So as you are looking for your first acquisition, you're looking for sort of putting some dollars together. The SBA alone might not be enough to do it. Personal resources might not be enough to do it. You want to make sure that potentially you have a strategic partner on your team that will be with you for the long term. We can come in and we can provide capital and advice. Not just advice to get you over the hump to a closing, but also to get you some view into what to do over the next decade. When we make an investment in a company, it's over the long term. And so this isn't really about getting in and getting out of a transaction. We're there for the long term. I've actually have two other general partners now. There's three of us, a team of three. We have some support on the finance side, actually out of India, and that makes up kind of the team today. We all have 25 plus years in our respective fields, and we have areas of specialty that really can come to light in some of the deals that you were doing. And so one of the things I always like to advise and caution is, if you're in the market for capital, it's one thing to take a check and then not need anything else. It's another to take a check from someone who actually has the capacity to help you in other facets of your business. So if you're in the market for capital, I'd love to talk to you about it. But also, if you choose, to derive your capital in other places, just make sure you understand where it's coming from, and think about it more than just a check that enables a transaction at a point in time. You really want to get a relationship. You want to have someone who's going to be commercially aligned with you for the long term, and is going to want to sort of nurture their investment as much as they want to nurture you and your investment in the business, because you're going to be tied to the hip for an extended period of time. So that could be me. It could be somebody else. And I'm actually happy to talk to you as well, just to even make that determination. All of you are juggling a lot of variables as you get to the closing, or any closing for that matter. In fact, you're probably working on a business right now. You don't even know if that's going to be the one. You may hope to, but you don't even know. So the amount of variables you guys are working through is pretty extreme. When you get down to the point of, okay, I like the business, I like the seller, I feel like I've mitigated my risks. Now I've got to figure out how to finance this thing. Happy to talk through that with you. Give you some ideas on how to think up through that. One of the areas where we try to help is really help the entrepreneur understand what it means to take on debt in an acquisition. The easiest way to think through that risk is, you're taking sort of these variable cash flows, you're buying historical performance on the business, and then you're going to essentially sell half of it to a bank. And that's your SBA loan. So if you think about, $1 million EBITDA business, it'll probably take you about $500,000 a year to debt finance that transaction. So that's what I mean by you're taking half the business and selling it to the bank. you're committing to give them the first $500,000 of that $1 million EBITDA you just purchased. The one thing to think through is that when you do that, you're essentially selling them the least riskiest portion of the business, which is the first 500,000. You get the second 500,000. But your cash flows are going to do this over time, especially in the early years when you're most maximally levered. And so helping entrepreneurs think through their capital strategy and their sources of capital, because once you commit to an SBA loan, that payment comes no matter what, coming every month. Which cash flows may not be. You know, it's easy to look at a 3-year schedule of cash flows. It's another to manage cash on a payroll cycle and on an SBA payment cycle and understanding how those dynamics work. So it can be very risky if you have the wrong capital structure and you're essentially selling off the least risky portion of your business, which is the first half of the pre-close EBITDA, to a third party who's expecting payment no matter what. So we help you think through those issues. Sometimes the business you're buying is at such a fantastic multiple that you can mitigate that risk just based on purchase price. There are other things you can do to mitigate risk when you find yourself in a competitive process and you're paying more of a fully priced transaction. So the discount isn't appearing in the purchase price, but you believe in the business. And so we're probably going to talk through raising excess cash well beyond what maybe a term sheet from an SBA lender may throw at you. If you're really careful what you sign up for, I know there's a lot of low down payment transactions that are out there. Like there's, 10% was, now it's 5% is the new 10%. And there's all kinds of stuff. I've seen some things, where people are like, hey, I'll just raise the down payment with a HELOC on my house, and I'm going to borrow the rest with the SBA. And so I'm like, it's basically 100% leverage, no cash out of my pocket. Those can work under the right circumstances, but also bring their own risks. So we're happy to talk through that. And there are lots of reasons why an equity injection from a group like mine or another group just like mine can be really helpful in first highlighting the risk, working it through with you, and then deciding whether or not our equity capital is the right match for you. So that's a long story short, but those are the things I hope you're thinking through. And even if you never call me or email me or forget my name in 10 minutes, that's fine. Just remember a few of those nuggets as you think through your transactions. Talk about a little bit about some of our special programs. I do want to highlight we have a special interest in investing in veterans from our special forces. One of our GPs is a retired Lieutenant Colonel Green Beret, and he's one of the guys I went to graduate school with at Rice University, and he is a partner of mine in 2 businesses. He's also a GP of our Fund 3 that we're launching this summer. And we've come up with a program where we're onboarding veterans of special forces and training them how to be effectively owners of aerospace and defense manufacturing businesses. We obviously did the original transaction with my partner Richard Hoover, and we have now seeded a new leader. We've had another retired, essentially service disabled veteran-owned business is the true specialty for special forces. We have someone embedded in our aerospace business in Denver for 2 years now, and we have an acquisition lined up, and they're going to take over, and we're going to finance that transaction for them and with them through the SBA. So we've got this program where we can train, we can prepare to operate, and then marry with them a business in the aerospace and defense line, which this is not the purpose of this call, but there's probably not a better owner-operator of an aerospace defense manufacturing facility than a veteran of our armed services. We have particular interest in special forces, but we'll look at anybody with a veteran track record. But I wanted to highlight that as an area of special interest. I can get you on the phone almost immediately with Rich I'll talk you through the program. We've got 4 or 5 guys actually doing it right now, and we're looking forward to closing a couple of those transactions at least this year. Another area of interest is course home services. That's the Acquira bread and butter. I even got sucked into one of those. I own a stone shop in St. Petersburg, Florida. 6 months ago, I hated it. We had 2 hurricanes, and no one needs countertops if their cabinets are gone. But we got through it, and I love it again. So when it comes to home services, the model's good. You need your plumbers, your electricians, you need your cabinet makers, you need your countertop guys. Those are all important things, and so we do love that space, and we'll continue to invest in it. So if you're thinking about doing that, please do it. We have a plumbing business in Miami. It's doing really quite well. I had 2 bolt-on transactions already in the past 18 months of ownership. It's doing really, really well. So bring those on. And then the third place we invest in is infrastructure. So that's because my background is based in it's wireless infrastructure, so cell phones and fiber optic networks and those sorts of things. An example of that, we just invested in an underground utility company last August. And just this week, I was able to make introductions to that company to some fiber operators. And we're going to expand their residential underground conduit business to include fiber installation. And now we're going to start pulling fiber all over the state of Florida. And we have clients like Florida Power and Light, Blue Stream, Zayo. All these guys are working towards the digital densification of data centers. So we like that kind of stuff too. So come up with a communication tower services company, anything in the data center space, conduit fiber, any kind of infrastructure, we're certainly happy to look at those deals as well. So we have 3 areas of focus. One is manufacturing. So with a asterisk and a highlight under aerospace and defense for our veterans. You've got home services and you've got infrastructure. Those are the places where not only can we write a check, and checks can be anywhere between 300 to 700,000, but the checks are with some experience. You access a portfolio of experience. The 3 GPs, we all have about 30 years each in our respective industries, and we are already owning and operating small businesses ourselves. So we've been there, we've done that, we're continuing to do that. We understand exactly what you are trying to do, and we know some of the tricks to get you there. We also know a lot of the warning signs. We do. And if we can help advise you into the best transaction possible, let us do that for you. And if it ends up with a check into your business, we're happy to do that as well. So with that, I guess to open up with questions, Andy.
I think we have one question from Dale.
Hi, Dale.
Hi, Chris. Nice to meet you. Hey,
You too.
just in the most recent workshop here this past weekend in Fort Lauderdale, and your name was mentioned a couple of times while we were there.
Yeah.
So I'm from the Pacific Northwest, just outside of the Seattle marketplace, and there's a whole bunch of aerospace manufacturing opportunities. I'm not a veteran. So is it the same, like still give you a call? Yes, even though I'm not the vet. Okay.
Yeah.
We can connect separately, but I'm curious to learn, just because it's an interesting niche for our region, what some of the nuance there is and why it's particularly interesting to you. And it's interesting to me just because it's fascinating, not because I have lots of experience. So maybe we can have a conversation about that.
Happy to do that. To give an example of how we can add value to an aerospace business, and if you're not a veteran, how you can actually participate in our veteran-owned businesses. So we have a service-disabled veteran-owned business strategy in our aerospace and defense line. And because of that, the company has preferential place in the supply chain for those types of contracts. So when you're in this sort of prototype and production small business area, there's a lot of interest in supply chain diversity and making sure that our retirees from the military are getting those business opportunities. Turns out, though, you can enter into a relationship with an SDVO certified business, which is our Denver business, and up to 40% of the revenue generated by that business can be tucked under by subcontractors who aren't service disabled, veteran owned. So, for example, I'm just illustrating, Dale, you go after a business in Washington outside of Seattle. You could become a subcontractor of ours. And as long as my subcontract to you does not exceed 40% of my total revenue, you would be treated like a service disabled veteran owned business because we would be writing the contract, right? And then you would be the subcontractor performing that. Now, that's not something I do for everybody. That's something I would do certainly if I was an investor in your business and looking to grow, the return on capital for our investors. Right. So that's an example of, it's not just the check into your business and we never call each other ever again until you're ready to sell. It becomes a relationship, and there's strategy and intent around the use of capital. And you may hear that proposition and decide that de-risks your business enough that you want us on your cap table, because it makes all the sense in the world for all the things that you're trying to work on, that you get a customer day one added to the business, because in the back of your mind you're saying, wait a minute, I just sold half the business to the bank, and now I've got to grow by at least 33% to get back to where I was before I bought it. So you're like, hey, everybody should be thinking about sales growth, sales strategy, revenue. How do I profitably generate more revenue, either at the existing margins or better, in order of the capital structure I walked into for the acquisition. So I just want to illustrate that example, as it can be more. It should be more than just a check.
So I'll collect some information and reach out offset. Thank you for that.
Yeah, great. Happy to do it.
I think we have another question, Luis.
Thank you. Hey, Chris,
Hi.
good to hear you. Hey, just out of curiosity, which niche of the aerospace industry is your business in Colorado?
It's aerospace and defense, and we do we do submarines, Tomahawk missiles, parts of, I should say, not the whole missile.
Okay, but would be like CNC machining, or,
yeah.
boards and circuits.
Yeah,
or...
it's CNC, it's lathe, it's mill, screw machine,
Okay.
all 5-axis, extremely high tolerance. We go down to the 10th of mil.
Okay.
In our manufacturing. Yeah, it's a pretty high precision shop, and we've also gotten into drones and satellites as well. We do a lot of work for RTX, Raytheon, Ball Aerospace. We just picked up SpaceX.
Okay.
So we're doing a lot of really cool stuff out there, down to the 4th decimal place.
But is it also machining with drones, or it's something totally different?
We machine parts for drones.
Okay, good. Thank you. Yeah, now good to know, because it helps figure out a good match. Thanks.
Yep. Satellites too. We like satellites.
Yeah, absolutely. Thank you.
Yep. Like another good match for a manufacturing business is the circuit board business. So
yeah,
small scale circuit board. We've got a partner down in Houston who's built a great business related to that, and that's a great tuck-in and a complement for a machine business, is to have the PC business, PC board business as well. There's a lot of custom circuitry, low volume custom circuitry that goes on in the U.S. And quite frankly, if you're following the news, anybody who can put a chipboard together is suddenly like the belle at the ball, given where the country is today.
Yes.
But those skills were around prior to the whatever the announcements have been, and we have a deep belief in that space, and we know that as we aggregate more companies in these areas of densification, business densification, we can actually bid and qualify for larger sub-assemblies of these larger components.
Okay.
And so teaming up and bringing that together is part of the larger strategy,
Okay.
right? So I may just do a RF radio housing for a missile today, one piece.
Yeah.
But now, because we got the chip capacity, we've got some other machining capacity, I can give sort of the whole midsection of the thing over instead of my
Okay.
purchase order being, a couple tens of thousands. Now the purchase order can be in the millions. So
Okay.
there's a lot of alignment that can happen with the right investments and adding things to the portfolio the right way. That's
Good.
complementary. So the
Yeah.
parts, some of the parts are greater than the whole is
Good.
greater than the sum of the parts, if you will.
Good. Perfect. Thank you.
Aaron. Aaron, do you still have a question? Well, this is your chance. Do you have any other questions to Chris?
I think Aaron has one. There's a hand raised on the screen, Andy.
Yeah. Aaron, are you still there? I'm not really sure if he's still there, but
Okay.
feel free to jump in if you do have any question, please.
Got a question from John.
Yeah, good to see you, Chris.
Hi.
I know you mentioned, or I heard you say at the beginning, you all are really focused more on like a longer term hold. So I'd be curious to hear, what is your typical exit strategy, right? As you're going into a deal with an AE, like ourselves, what are you thinking on the back end of a deal in terms of, returning investor capital and all that?
Yeah, so I see these as 5 to 10 year investments. When we structure funds, they're 10-year funds with a 3-year TAC, just in case extra time is needed to exit the fund. We have represented to LPs that we would exit in cash, not private shares. So we are looking for cash exits. I don't expect to see exits until year 7, 8, or 9. But there's lots of ways to kind of give us the boot when you're ready. One is the easy way is we ride along with you the entire time. And we do some kind of an exit transaction together because the time is right. It makes a lot of sense for both of us to do that. But you can also refinance us out. Once you get to about the midpoint of your SBA loan, we're going to be having some really interesting conversations about your capital structure and what your long-term growth trajectory is. And hopefully you've outgrown us, right? So just like an angel investor has a role to play in the VC space, I'll take the name of the angel investor in your deal, and I'm going to have a certain life cycle with you. And so my goal is that you outgrow me, just like your goal is to outgrow your SBA loan. So when you graduate to a more longer term debt structure, when debt becomes no longer this amortizing thing that you did to get your acquisition done, but becomes a permanent part of your capital structure long term, that's when I've played my role, right? And we're shaking hands, and hopefully I'm going to all your kids' weddings, and we've had a good time doing it. But there's definitely a life cycle for me, and I say it's that 5 to 10 with a kind of at the midpoint, call it 7.5, 8 years is where probably will have far outgrown me.
Okay, great. Thank you so much, Chris. Appreciate it.
Sure.
Hey, Chris, this is Dana Bickford.
Hey, Dana, how you doing?
I'm well. Thanks for doing this. Where are you located?
Home base is Houston, Texas.
Okay. Okay. I'm up just north of Dallas, and have a friend who is service disabled Marine Corps, and might be interested in something like this. I may try and make an introduction.
Yeah, please do. Please do. We've got a nice group of guys with a similar background who are all pointed in the same direction on these acquisitions.
Yeah, great. Appreciate you doing this. This is good information for everybody.
Yeah, absolutely.
Aaron posted his question. He's asking, what is the minimum business size that would make sense for your team to come in? What is the maximum size deal or investment? And lastly, how much of the business needs to be vet owned?
Okay, so the easy question is vet owned is 0. To clarify my comments, we have a special little program where we like to do service disabled veteran owned investing. That is not a requirement for all of our investments. I just wanted to highlight there's this fast lane that we have created for that special type of owner because of the owner operator match that we see so strong and valuable in the aerospace and defense business. But that's just a wedge of the pie. The rest of the pie, it can be anybody. Don't care, right? It's really more about the person, the business they're choosing, and what the path of growth looks like. And John, by the way, one of the things that we talk about is the path to 2 million EBITDA, which I see as a big stepping stone. So I'm going to answer kind of two questions. I went back to John's question. I'm going to go back to Aaron's again. I like this $1 million EBITDA line. It's a good number. You can go under it. You can go over it. There really is no upper limit, but you probably find you're dealing with a lot larger professional PE firms. They're going to scoop that stuff up at multiples that will scare you to death. So that $1 million EBITDA line seems to be a good place because even after half of it's gone, because you sold it to the bank, you still have $500,000 left over to do the things like you're going to lose customers because some of the customers are going to be personal to the owners, and no matter how much everybody likes you and you doing the deal, you're going to lose some customers. So you're going to have some revenue drop initially. Gives you time to replace those customers. Gives you time to make mistakes. It gives you time to realize that maybe the working capital estimate you came up with isn't quite enough, and you got to go figure out what to do next. By the way, these are things that we help you with. Post close, the truth is always found after the close. So those sorts of things, you're a little bit of a cushion, right? $500,000, it's not a lot if you think about it on a monthly basis. What's it, less than 50 grand a month? Sounds like a lot, but it's really not. When you're also spending $50,000 a month on just your SBA loan, you've got a $45,000 payroll every 2 weeks. You got rent coming in, maybe that's 10, 20, 30,000 a month. So those numbers add up pretty quickly. So you got to give yourself some room. If you buy a 200 EBITDA business or a 500 EBITDA business, and then you give half to the bank, you got 250 left. You got to pay yourself something, and you have to cushion yourself for mistakes. And that's a whole other probably master class in how do you operate the first year to 2 years? What is the correct working capital calculation you should be using? And how does a rigid capitalization structure like debt impact working capital assumptions, which probably all the time are wrong? That'll be my teaser for a masterclass in working capital. Not a lot of small businesses really understand how much capital is sitting in the working capital. And their financial statements are really usually pretty poor estimates of what it is. So I always advise towards a lot of hedging when it comes to working capital calculations, because it has a direct implication on your capital structure, your ability to service a regular periodic debt payment, and the volatility of the cash flows that you're inheriting. Everything looks smooth on an annual basis. You might be able to see your chart go like this. But as you know, it's this. And you're probably looking at it monthly, but you'd be surprised how many nightmares exist in the daily and the weekly cash flow of making payroll. So all those things come to bear. So that's why I tend to lean up, $1 million or more of adjusted EBITDA. And that can also be where a capital source like ours can be helpful, because your personal capacity may get you to that 500 EBITDA line. But now you've got to think through some of the risks I just highlighted. And you might say, you know what, that's a bumpy road. But if I do a larger transaction with a capital partner, I could get into that $1 million EBITDA zone and have a little bit more of a shock absorber built into the business that I'm buying. And then have a partner who can add value, for example, like the machine shop example that I gave earlier to Dale. All those things come to bear. I started this presentation today talking about all the variables you guys are juggling. I probably gave you a whole bunch more today, but those are things you got to weigh. Those are all important factors. And so for those reasons, $1 million and up is the ideal target. There are plenty of reasons to do stuff below $1 million, as long as we have a clear eye on the risks that we're taking on, and we have the right capital reserves in order to handle those shocks that will invariably happen. But shoot for $1 million or more, and we're happy to be the bridge if you need a bridge to get there, or just be a smart add to your cap table, because having an investment from us just makes sense for what you're trying to achieve.
And Chris, we also receive a couple of questions. So first from Hassan, to clarify, the special program you mentioned, is it only for disabled veterans or for veterans in general?
We look at veterans in general, but we have a very clear view on the SDVO track, which is a special classification that the SBA grants as part of the business acquisition process. But we do our best to also work with any veterans who are interested in business acquisitions.
Got it. And another one from Josh. What is the expected investment multiplier? And then, well, specifically, what percent of ownership does Acquira expect in return for the investment? Also, is there a requirement for the legal structure of the business?
Yeah, those are good detailed questions. We're typically looking for something less than 20% of the business. Even if we're delivering the majority of the equity into your transaction, because we recognize the fact that we're not the operator, you are, and you should be the true owner of the business, which means you have control. Two, we also value the fact that you're going to have a personal guarantee on an SBA loan. We should count that in part as part of your capital, right? You're putting your name on it, it's part of your capital. So while we're typically bringing the majority of the equity into a transaction, it doesn't mean that we're the majority solution in terms of the totality of what's being brought to the closing table. So we usually end up somewhere south of 20%. Our transactions typically have an accrued 10% coupon. There is a typical private equity waterfall tied to that. There may or may not be a liquidation preference depending on the quality, the value you create at the exit. But that's all pretty typical stuff. I forget what was the balance of that question, Andy?
Well, the last one was if there is any requirement that the legal structure of the entity,
Oh yeah,
like
yeah,
be a
thank you.
corp.
Yeah, so we like C corps. One of the ways we like to invest is on a dividend basis, and we tend to stay away from pass-through entities. To the greatest extent possible, we like businesses that can be structured to qualify for the 1202 exits, which is why we have a passion for things like infrastructure and manufacturing. Home services can be a bit of a mixed bag on 1202, but there are definitely 1202 exit opportunities there as well. If you haven't read up on founder shares and 1202, which I think is probably part of your Acquira core curriculum at this point, Google it. It's worth a look. It's a great way to shield taxable gains, capital gains forever in a sale of a business. It's like 1031 exchanges for real estate on steroids, right? Because on a 1031, you eventually pay. You're just kicking the can down the road. A 1202 transaction properly done, those taxes are waived forever, right? So it's a great way to defer taxes. Our view is that keeping dollars circulating at the corporate level and only being subject to a 21% corporate rate allows you to sort of store cash at the corporate level, manage your taxes while it's at the corporate level, Then you only distribute when you're ready to distribute a dividend, which allows you to control your taxable outcome. Then we have a goal on what do we need to do to make your business 1202 qualified. So we have a strong preference for C Corps for those reasons. If you have a compelling proposal that doesn't hold C Corp, I'm open to it.
Frank, do you have a question? Okay, thank you.
Hi, Chris. Thanks for the information. I just wanted to say hello because I'll be reaching out to you about the about the military program. I meet your preferred criteria, so just wanted to say hi on here before I reach out via phone or email. Or
Frank, I look forward to that. Thank you for your service, man. Appreciate it.
oh, thank you. I appreciate appreciate the program and you being on here today.
Yeah, absolutely. We'll have to get you tied up with retired Lieutenant Colonel Hoover. You guys can
Awesome.
tell war stories to each other. It's secrets I can't hear.
Sounds good. Sounds good. I'll write his name down now.
I see your hand. Do you have another question? Maybe you can post it in the chat if you're still having issues with your mic. Well, before we wrap up, do you have any other questions for Chris? This is your time. Well, we still have him here. But
Well,
definitely
I'll-
using the contact information.
I can
After
throw
doing-
another question in, Andy,
Yeah, sure, Dale.
Sure.
since we have time. So what's the appropriate time in the exploration of an opportunity to be in touch with you? How early do you want to look over our shoulders and have conversations about potential deals?
Yeah, hit me before you send your first LOI
Okay.
out of the deal you really like.
Okay, so early.
Yeah, there are some things that we may want to make sure you have in your LOI, or at least have thought through, because we've raised them, to make sure that you get into a deal that is closable from an equity, perspective. There are certain things based on what you're doing that we'd want to see. So it's a great time to have that conversation. It's also a great time to figure out whether or not we're a really good match for you.
Yep.
Right. And if we're not, we can potentially help you find other sources as well. We're here to help, so we're just one door of many.
Mhm.
So we're happy to have that early. We've gotten caught a few times where we came too late in the process,
Mhm.
and it was a rush. And there were just some things missing in the deals that really made it difficult for us to sort of get comfortable. So it's not for today's session, but it's really better managed on a per transaction, because there's really it's not a universal guidebook or not checklist. It's, what's going on, what are you doing, why are you buying it, what's it going to look like when you're done, type of conversation, and what's the path to 2 million, John, right? So everybody should have a clear view on how do I get to 2 million EBITDA, because you owe it to yourselves, really, honestly. You need to have a clear path to 2 million EBITDA. And if you're already over 1 million, I'll just double it. So if you're at 1.3, it's now 2.6. It'll at least be 2.
Good stuff. Thank you.
Yeah.
Well, maybe talk about, since someone else is jumping in, maybe talk about some of the things that make us not good fits.
Yeah. So not good fits are, I'll say like lifestyle buyers aren't really good investments, from the investor's perspective. So someone who says, I'm just going to buy a business one a year. I'm not going to run them. I'm just going to I'm just going to buy them. I'm just going to buy one every year. It's really going to be easy. So I can go and race cars on the weekends or do that kind of stuff. As an investor, someone is the steward of other people's capital, that's a hard story to tell as to why you're investing in someone. Right? So we're looking for grit, perseverance, someone who's going to, own the transaction and own the growth and own the story. It's okay if you build a team. We expect that, right? We expect you to grow it to a point where you can take off the general manager hat and keep on the investor hat. But to go into it like you're going to just write checks or ask other people to give you money so you could write the check, that's not what that's not what we do. Right? So that's an example of a bad match for us. And I know there are people out there who have written checks, and I'm sure they're fine. It's just not investable, because when those go south, the why you did it becomes very, very uncomfortable for me, because I have a duty to my investors to find the best investments and to put their capital where I know it's going to be stewarded and cared for, right? Just as much as someone else's own personal capital. That's what we're really looking for. And when you break that, you create a conflict of interest. Those become the uninvestable deals. Also, uninvestable deals are people who have just I say almost like a naive view of how easy they think it's going to be to operate a business at this scale. That is a huge challenge as well, because we want people who will collaborate. When we're making an investment, it's a long-term relationship, and there's going to be some back and forth, but we can't have people who keep doing these forecasts that keep going like this, up into the sky. Right? You just can't go. It's just business is going to do this, right? Hopefully it does this way. It goes up a little bit every year. It goes down too. We just have to have a realistic, practical view of what it takes. And people who just keep looking at the chart skyrocketing up in the air, it just doesn't work. It's unrealistic. And if it's uncoachable, what are you going to do? You just got to take your chips and go somewhere else.
Chris, what about AEs who take out an SBA loan for 70 or 80% of the business? Do you still entertain them? Because we advise them to go up to that, occasionally up to 90%.
Mm-hmm. Yeah, so a typical deal is 90%. And I've even seen some 95% deals. And that can be fine. You just have to be very cognizant of what you're doing, because when you 90% loan to value, you are selling half your business cash flow to the bank, right? And that's a metronome payment. It's coming. And so we have to have a real clear view on what are the capital reserves beyond that in order to weather the storm. Some of it will come from the other half of the business that you've retained.
Right.
Some of it's going to be activities that you undertake to mitigate that risk and to sort of grow back out of that risk you just took, right? So that's the idea of you sell half, you got to grow by a third to catch up again, get back to break even. All those factors come into play. And there are some cases where, as I said before, if you're doing a 90% loan to value on a 2 or 2.5 multiple deal, your risk profile is completely different than a 90% loan to value on a 4x or a 4.5x deal, right? So there's lots of things at play. But I wouldn't worry about the leverage point itself. Obviously, less debt's better. It's safer. As you increase your debt, you increase bankruptcy risk. That's just fundamental to it. But there are mitigation strategies, and some of that can be bringing excess capital into the transaction beyond what an SBA bank would maybe require from a paperwork perspective. Like, it's approvable, but should you do it? Like, those are two different, right, valuations. And so please don't rely on the fact that a SBA lender gave you a piece of paper is your mandate to close. Like, you should do this deal because a banker said they would make the loan. That is just one piece of your underwriting journey. And please don't rely on that letter as your absolute green light. There are lots of folks who get in trouble who close deals with that bank letter in hand. And they've gotten in trouble. So that's one piece of the pie. But yeah, 90% we can do it. Thank you, Penelope. Good to see you again, by the way.
Thank you. You too.
Looks like we have a question from Ben.
Yeah, Chris, I've got a question for you.
Yeah, hi, Ben.
Could you just, and I know you've thrown some of these numbers out here just casually, but could you walk us through kind of an example of how much equity you would purchase in the business? Like, let's just say $1 million in EBITDA at a 3x multiple, right? Like, how much capital you look at investing, how much equity you'd be willing to purchase, and then let's say we doubled that EBITDA in 5 years or whatever the term is. What that exit would look like for you on a cash exit, and like what the dollar figure is for you on that exit to buy you out.
Ben, I appreciate the compliment that you think I can do it on my head on the fly right now. There's a lot of variables there. I can tell you it's always going to be under 20%. My targeted invested return is 5x. Right, so that's what we're looking to do. That's why it takes such a long-term time to generate those kinds of numbers. So we have investors who have invested on the basis of a 35% IRR and a 5x return. Your goal and my goal would be to meaningfully exceed that for yourself and for the fund, because most of my compensation comes if I can get investments above 5x, and I can only do that through growth.
Okay. I mean, I don't know. Let's just play it out, right? Let's say $1 million in EBITDA, 3x multiple. You buy in at 10% of that. You write me a $300,000 check, right? Are you buying in at 10% of the business, or are you expecting 20% of the business for the 10% equity up front?
It's going to be somewhere between 10 and 20%.
Somewhere between.
There's also going to be a preferred coupon tied to that accrues at about 10% on average, if your risk profile ends up being sort of down the fairway.
Okay.
So preferred equity has a debt leg and an equity leg. Right. So there is an accrued preferred return that goes to the waterfall of the payouts, and then there's the equity sharing on the residual. That's done both on an operating dividend and on an exit basis. And so all of those factors come to play when calculating the 5x return and the 35% IRR target on the portfolio at large. And so when we develop that portfolio return, we have to bake in that some of the investments we make will underperform, some will overperform, but we're trying to zoom in on that 35% or better IRR is kind of the target. And it depends on the business that you're in, where you land and all of that. But in your example, you're arguably saying that the fund would be paying 100% of the equity injection in that transaction, potentially. Some have asked us to do that before, and that's a little riskier for us. If you were putting in 300 and we were putting in 300, so we were 20%, and the seller was holding another 10% equity rollover, and there's a 10% seller note, so it was a 60% LTV, that totally changes the transaction than someone who's putting in 50 grand and asking for 300,000 from the fund. So there's lots of things that happen, Ben, in the cooking, right, in the recipe of a transaction, including what is the business and what is the investor owner match that comes into play. So it's really hard to sort of back of the envelope calculate what the capital costs globally in a call like this, where everyone's deal is going to be a little different or a lot different.
Okay. So I mean, let's say we took the EBITDA and we doubled it, right? Let's say enterprise value goes up from a 3x multiple to a 4x multiple. So we're looking at an $8 million business versus a $3 million business when we purchased it. You've got 20% of the business. So would the buyout at that point in 5 years, would that look like a $2 million buyout, or 1.75, or whatever the 20% is?
Yeah, whatever the number would be. Yeah, that's right.
Okay. Plus the preferred coupon payouts over the life of the business, right? If there are any distributions.
That's right. Yep, during the operating period. Absolutely.
We deal with it, Ben, in course 102-4, Understanding Equity Investment. We go through a whole case and show enterprise to equity value conversion. So they put in 10%, but they get 25% ownership, for example. and what it's like at the exit for both the passive investor and the operating investor.
Yeah, and Penelope, I have not found a reason in quite some time to go over 20. So it might be, if you're using it like a 2.5 on, so as a general rule of thumb, I think you could soften that up on the pro forma.
Okay.
Yeah. Yep, understood. I saw the training. The training was super helpful, very clear. Wanted to understand what Chris's figures were in his deal structure.
Yeah. So you're saying you're more 20 as 2 times as opposed to 2.5 times, Chris?
Yeah. There are typically, Penelope, at different thresholds. So there's the percentage of the operating dividend that we're looking for, which is typically less than the portion of the exit.
Yeah.
So depending on how the entrepreneur wants to structure the transaction, how they want to actually pay for the preferred investment over time, and whether or not they're going to use an operating dividend to pay down the preferreds as the investment continues, it changes things sometimes meaningfully. So it's hard to solve for this over a call as a single performer example, because a lot of it has to do with what is the entrepreneur looking to do, what kind of capital they have, what are the risks of the business, and what's the best structure for all parties involved.
All right, well, we'll do a quick last call for questions.
Thanks, Andy.
Yeah. Speak now or forever hold your peace.
Yeah. See, Ben, when the math always gets people to, like, everybody gets quiet when the math starts.
That's why I got to ask the hard questions.
Yeah, leave them to the end, right? So, and if you ever want to scrimmage a deal, just reach out.
Yeah, and I might want to do that with you, so I'll probably email you and set up some time.
Yeah, no worries.
Thanks for all the insight today, Chris.
Yeah, happy to help. If I am not your partner, that's okay. I hope that you got some nuggets and some extra things to think about on your acquisition journey. And if I can be helpful, please don't hesitate to ask. I'll be happy to play that role.
Thank you, Chris.
Yeah, thanks, everybody. Take care.
Appreciate it.
Thanks, Andy, for hosting. Appreciate it.
Thanks, everyone.